The O Cannabis Conference and Expo returns to Toronto June 1st through the 3rd, and there's still some good booth locations available. This exciting event is free for cannabis retailers and will feature Tommy Chong receiving a Lifetime Achievement Award at the O Cannabis Industry Awards. For more information about exhibiting or to register to attend, go to ocannabis.com. That's OCANNABIZ.com. Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today we're going to do a financial market review. A lot to cover, so let's jump right into it. So last week, Goldman Sachs triggered a sell-off when they pointed out that the 5 largest S&P stocks, that's Microsoft, Apple, Amazon, Google, and Facebook, they've all risen about 20%, representing the highest concentration on record. And it's interesting to point out that although the S&P trades just 14% below its all-time high, the median S&P constituent still trades 23% below its record high. So year to date, the 5 biggest stocks are up 10%, while the remaining 495 S&P 500 companies are lower by a collective 13%. All right, let's take a look at some leading economic indicators, starting with the auto sales. According to Edmunds, they believe that April will be a record down month for the auto industry. So this reflects a 52.5% decrease in sales from April, 36% decrease from March. So analysts note that this would be the lowest volume sales month on record and the second worst month for sales in the past 30 years. Last week, we mentioned that oil was being parked out in the ocean as rates went negative. It was basically they couldn't find anywhere to store it. So with $57 negative for May's future, rather than the producer paying to get rid of it or store it, they just decided to park it out in the ocean with these tankers. And the same thing is happening for cars. You're seeing SUVs being parked in the middle of the ocean as the auto inventory crisis deepens. An executive director at the Marine Exchange of Southern California said it's very abnormal for a container ship, a car carrier, or a cruise ship not to go right to the berth, discharge, and be on their way. The Port of Hume's director and chief executive officer said that you can't stack cars. They even looked at using a Ventura County fairground. So desperate auto dealers are betting big on discounts to help try to move some of this inventory. You're going to start to see an extension of loans, so beyond 84 months, 0 down, 0 at signing, 0%, and then discounts off the purchase price. Hyundai and Mazda reported drops of 39 and 45% respectively. I wouldn't doubt it if the U.S. government implemented a cash for clunkers deal where they'll just destroy all the cars that get turned in for probably 120% of fair market value in an attempt to try to save the industry, but it's not going to happen. There's going to be a lot of consolidation in the U.S. for automakers. Most of them won't survive, including Ford. They didn't take a loan last time, but they're not going to survive this time. They stopped making all cars last year. They were only going to make trucks, and so that's not going to help them long term. The chief executive for the retailer Sonic Automotive called the existing loans unprecedented, and his belief is that the demand will come back fairly well. You can tell I'm not very convinced. Not too long ago, I saw used cars that were more expensive than new cars, and that was late 2018, even 2019, and it started in trucks, which is the last thing you would expect because trucks are used for work, not leisure, pleasure. And so those are the last things to be discounted. And yet what we're seeing, at least with some of the pickup trucks, is that the new pickup trucks were cheaper than used ones. And so that's not a very good indicator. So as you can tell, something odd is going on around with the automotive industry as parking lots are filling up. It's not just fairgrounds and it's not just on boats in the middle of the ocean, but you're seeing city sports complex parking lots now being used for rental car companies. Even Wells Fargo was letting Enterprise park more than 2,000 vehicles free of charge. In Southern California, there's rental cars filling up parking lots at Dodger Stadium, in LA at Angel Stadium. And even here in Seattle, I'm seeing Nissan buying out an old ice cream shop and then parking all of their vehicles in that parking lot. So as I mentioned, there's a record 375 million barrels of oil that's being stored on tankers overseas. In the past 5 weeks, onshore inventories held in floating top tanks climbed 180 million barrels, suggesting that builds have averaged roughly 4.3 million barrels since mid-March. Meanwhile, the Fed's been busy printing to the tune of $6.66 trillion to try and keep the economy afloat. Investing legend Kirill Sokolov sees a second Great Depression for stocks by 2023. If the Federal Reserve continues to print the money the way they are, it's going to deteriorate some of the peace of mind that bondholders have. And since the dollar is only backed by the full faith and credit, you can see from this graph what happened the last time it lost faith and had too much debt. You can see in the blue, that's currently, and then red, 1932 crash. So we could potentially go down another 50%. So the U.S. is expected to borrow a record $4.4 trillion in 2020, more than the previous 5 years combined. Treasury expects to pay down $56 billion in privately held net marketable debt. So between April and September, the Treasury will borrow a record $3.7 trillion. So that's going to expand the Fed's balance sheet by 38% of GDP, more than double of QE1, 2, and 3 combined. There's a number of high-frequency indicators that are being tracked that are suggesting that the global economy is in the process of bottoming out. Consumers' future expectations have improved. Mobility trends have moved up from their troughs, and consumer spending is contracting more slowly than in the early weeks of the outbreak. It says here that restaurants have 50 to 80% of their customer base back, but nightlife venues are still closed, as well as cinemas until early June. I'm not seeing that, though. Let me know if you guys are. I'm not sure that 50 to 80% of the people are going back out. Bank of America even said that buying stocks here only makes sense if the Fed is buying it too. There's a saying, don't fight the Fed. Don't go against what they're doing. We also reported last week that somebody mentioned investing is dead. Only do what the Fed is doing. If you were just to look at the equity prices, it would imply that looking at them is either a record short recession or that the Federal Reserve is just buying up equities. And we already know that. BlackRock is buying up equities. They came out initially saying they were buying junk bonds, high yield debt. And so now they're buying ETFs. Those aren't even real companies. That's just an index. Let those speculators go to the wayside. Who cares? So this is crazy. They're just buying up everything following Japan. So you could see the S&P melt up to 3,000 before rolling over and then returning to lows. Bank of America points out to the unprecedented $12 trillion in stimulus, which could further divorce asset prices from economic reality. They also point out that the S&P's forward price to earnings ratio is at 20%, and it's only been higher during the tech bubble and 2020. All right, so expanding on this point, we can see that the 1987 crash had an average S&P forward price to earnings at 10. The tech bubble was 16, and the great financial crisis was at 14. So we're at 20. So this is really expensive right now. So Bank of America concludes that equities are either betting on a record short recession or on the Fed buying equities, believing fundamentals don't matter. So if the Fed is out buying equities, stocks, bonds, maybe they'll be buying real estate investment trusts and maybe mortgages. I don't know. Right now we're seeing collateralized mortgage-backed securities imploding. There was a record 66 loans totaling $1 billion that became delinquent in April. It's the greatest month-over-month change. Some of these delinquencies and soon-to-be defaults all stem back to stay-at-home orders. A lot of the commercial companies weren't paying their rents right up front. We're going to start seeing that on the residential side too. So it's going to hit Wall Street first. Maybe the Feds prop that up, but I'm not sure that prices will hold up long term. So in addition, there was 922 loans totaling over $14 billion added to a watch list in April. So there was a record 3,316 loans with a record balance of $51 billion currently on the watch list. So commercial real estate, it's a disaster. Retail sector is going to be a disaster with the barrage of hotels just as bad, as well as multifamily collateralized mortgage-backed securities. Here's a couple graphs to try to explain why assets will crash. You have the increasing concentration of ownership of wealth and assets in the top 10%. The chart illustrates that the top 10% own 84% of all stocks, over 90% of all business equity, and over 80% of all non-home real estate. Of the more expensive assets, the greater the concentration of ownership, as the top 5% own roughly 2/3 of all the wealth. Now the top 0.1% own more than the bottom 80%. So Goldman Sachs is expecting a biblical wave of bankruptcies to flood the U.S. There's been a record amount of debt by fallen angels, which are multi-billion-dollar companies have been downgraded. So $148.8 billion in the first quarter. It's the record amount for fallen angel bonds. We could see a series of more downgrades as the signaling from the rating agencies also remains negative. So there's a large portion of triple B rated debt that could be downgraded. This graph from Deutsche Bank shows U.S. commercial bank loan delinquency rates that dropped steadily after 2009 from a high of around 15% down to 4%, and then spiked pretty much overnight back to 15%. So it's hitting individuals, not just businesses. We can see from the unemployment rate as well as Chapter 11 bankruptcies that the unemployment rate skyrocketed to 20 million. So we're going to see Chapter 11 bankruptcies that were coupled to the unemployment rate probably also skyrocket parabolic along with it. So what are some solutions? Probably precious metals. That's what I'm doing. Silver and gold. We'll take a look at those, asking if gold will really hit $3,000 an ounce within the next 18 months. Let's first look at the opportunities for silver. It hasn't been this cheap in 5,000 years with the silver to gold ratio. So that silver to gold ratio is right around 112, meaning it now takes 112 ounces of silver to buy 1 ounce of gold. Today's level is splitting the distance from the ratio's all-time high of 120, which it reached last month. Right now, in fact, the price of gold is relatively cheap compared to the current money supply. The price of silver is ridiculously cheap compared to gold. So I can't be certain about anything. There's a strong case that could be made for the price of silver could soar to catch up to gold. So let's not forget that if you own an ETF for gold or any other precious metal that you're never going to have tangible, it's 65 times oversubscribed. China might not wait to implement a gold-backed currency. So post-pandemic, they may try to implement a digital, cash-free option here. So this might be interesting because it looks like there's a couple of sites where they say there's a mobile app that's being developed by the Agricultural Bank of China that's already circulating on WeChat. And they're saying that they're cautious in terms of risk control and anti-money laundering, know your customer. And they're going to say that, paper and the virus gets attached to paper money. So all of that kind of adds up to a cashless digital option, but it might be backed by gold. A well-connected banking source in Hong Kong said that there's a digital sovereign yuan that may be backed by gold. So gold could serve as a direct backup for bonds and collateral. So if Beijing announces a digital currency backed by gold, it will be a death nail to the US dollar. Here's a couple other reasons why I'm picking up precious metals. We're seeing for the first time ever, more than half of the US population is not working. And yet the NASDAQ index has grown bigger than all of the world's stock market combined. Stocks soar in response to the record rise in unemployment. So again, after a record amount of unemployment, nothing says like buy the fucking dip, like the worst jobs market in U.S. history. Dow futures spiked over 150 points on the terrible data. Stock buybacks are back. You got stocks soaring even as equity outflows hit a 2-month high. So nobody's buying but the feds. And so companies are jumping on board saying now's a good time. And everyone else is piling up cash to record levels. So with Apple leading the NASDAQ and the broader market, the S&P is now back to its post-crisis high. So what better time for Apple to activate an $8 billion buyback? The funds are coming from $8 billion in bonds that they're going to issue in order to repurchase stock. That is absolutely crazy that you're going to sell debt in order to buy equity. That's insane. Oh, and of course, Apple stock is up 5% since it reactivated its buyback. And for the first time ever, futures prices are negative in the U.S. starting December 2020. Fed fund futures soaring to contract highs with the first priced in negative rates now shifting from January 2021 to December of 2020. There's a whole lot of jibber jabber about when the economy opens up, people are going to be going back and everything's going to be back to normal. But you have 52% of small businesses expecting to be out of business within 6 months. So this is based on a recent survey, and that's going to have downward effects. Millions of small businesses aren't going to be able to survive in a depressed economic environment for very long. In America today, the rules of the game are slanted heavily in favor of huge corporations or slanted heavily against small businesses. Good news is that the lockdowns are starting to end, but the bad news is many of them won't be facing any new normal in which their monthly revenues will be down 30 to 40, maybe even 50% or more. You can already see that in Texas, where you have malls reopening, but people preferring to go to the beach and parks instead. So while a dozen or so people were strolling around an open air shopping center, didn't seem like anybody was actually buying anything. Someone said that there's absolutely nobody coming around here. Meanwhile, there's an explosion of people returning to normal activity like beaches, public parks, lakes, rivers, natural areas. And while that could be because it's spring, everyone wants to get out at the beginning of summertime, it's also because disposable incomes are low, people are out of jobs. So Bank of England is warning that it could be the worst economic slump in 300 years. Looks like UK's employment activity was cut in half just in 2020, with inflation raising about 2%. And that's a tough tax for the poor, regressive taxes. I use beef jerky as an example for inflation. About 5-10 years ago, price of 1 pound of beef jerky was $10, and now you find 8 ounces for $10. So up until now, there hasn't really been a shortage of beef or any kind of meats, and there still isn't yet. There's talking about it, almost kind of like they're trying to make that come to fruition to starve us all. But inflation is coming, so maybe that deflation occurred, and now we're going to see hyperinflation. Maybe you could seesaw back and forth. We'll have to wait and find out. So the global markets are in turmoil, and so I'm going towards precious metals now because, again, ETFs are oversubscribed at least 65 times. And so if you wait too long, they may not be available. We can kind of see decoupling from spot price to actually physical price. And so we can see silver coin premium soaring. Global silver demand nudged even higher in 2019 thanks to a 12% increase in investment demand as retail and institutional investors focused their attention on the long-term investment appeal of this precious metal. Silver historically outperforms gold in a bull market, with investment demand growing to the largest annual growth since 2005. Meanwhile, silver mine supply for the 4th straight year with output declining 1%. We've seen the U.S. Mint shut down due to COVID, Canadian Mint, Swiss Mint. So all of those are creating even more FOMO people and countries, federal banks, central banks, everyone running out trying to buy as much precious metals as they can. So eventually it's not even going to be available. That's why I'm stocking up. So invest wisely. With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.
Hi, it's Justin Benton, host of the Miracle Plant Podcast, where we discuss this miracle plant that goes by so many names and how it's helping people in so many extraordinary ways. So if you love this plant and you want to hear a story that tugs on those heartstrings and learn more about this plant, then head on over to the Miracle Plant Podcast. You'll be glad you did.